Ladies and gentlemen, welcome to the second quarter June 2011 webcast for Cadence Capital Limited. This webcast coincides with our half-yearly results, and I'd like to initially go through the half-yearly results and then take you through our top 5 positions at the moment. We reported a strong profit increase of 31% for the half-year results for the first half June 2011. Our profit after tax increased by 33% to nearly $7 million, and the gross portfolio for that period has performed around 42%, outperforming the All Ordinaries accumulation by around 28%. The gross portfolio for the period has, for the 12 months, is up 32%, outperforming the All Ords index by about 29%. This brings our 5-year gross performance to 126% roughly, outperforming the All Ords accumulation index by around 100%. And our annualized numbers per annum are around 18% per annum against a market that has done around 5% per annum, meaning that we've outperformed the market by about 13% per annum for 5 years. We've announced a record interim dividend for the period as well. The board of Cadence Capital Limited are committed to paying an increasing dividend stream to our shareholders, and on that basis we've declared a 3 cents per share interim dividend on the 22nd of February, and it's to be paid on the 14th of March 2011. This is a 50% increase on our interim dividend from last year. Since commencing our operations, Cadence Capital Limited has declared 36.5 cents of fully franked grossed up dividends. The dividend reinvestment program is in operation again for our interim dividend, and we would highly encourage people to have a look at that DRP. That allows you to buy shares in Cadence Capital Limited at the current share price, which is trading at a significant discount to the net tangible asset backing of the underlying shares. The discount has been anywhere from about 20 to 30% discount to the underlying NTA, and that discount is at around those levels at the moment. So we would highly encourage people to have a look at the DRP program for the interim dividend. The following slide shows the alpha generation, or the excess return above and beyond the All Ordinaries index that the fund has generated since inception. And I think you can see over time that that alpha is increasing, and that the alpha that we've generated has been consistent over around 60% of the time that we operate. That is an increasing number, and very pleasingly has never actually been a negative number. It's always been a positive alpha generating environment for us. At the half-yearly result, we've broken down the sectors in which we've made profits and also the areas in which we've made losses, and the following graph illustrates the returns that we've made, where we've made them: in materials, banks, software and services, commercial and professional services and insurance, and we've lost money in telecommunications and services, technology, hardware and diversified financials, as well as a little bit in real estate and other sectors, consumer services in particular. Now, the other pleasing thing about that chart is that it shows that our returns on the positive side have been significantly greater than our losses on the negative side, and that shows that we are limiting our losses and letting our profitable positions run. The performance by stock has been broken down on the following slide. We've made good returns from RHG, South Boulder, Bravura, Macmillan Shakespeare, Tower, which has now been taken over, Cape Lambert and Reckon. On the downside, stocks that have underperformed for us over the period are TPN and Miko. The following slide shows that over time our winning positions are becoming larger proportions of the portfolio, and as you would expect, they become of longer duration. I guess what that says in practical terms is that we are adding to our winning positions and holding them for long periods of time, and we're cutting our losing positions, and the duration of those positions is much shorter, and that's a pleasing trend that we hope to continue. Ladies and gentlemen, I'd now like to focus on the top 5 positions within our portfolio and go through each of them in a little bit of detail. The largest stock in our portfolio at the moment is RHG Limited, and based on their half-yearly results, they have $1.06 of NTA per share. Actually, the majority of that NTA is held in cash at the moment, and we believe that that number is increasing over time as the company continues to earn cash, even though it is in wind-down mode. The company announced at its AGM in November that it was to try and initiate an 88 cents buyback with 30 cents of franking attached to it. This has a pre-tax value to Cadence Capital Limited shareholders of $1.18 per share, and we are awaiting the ATO announcement decision on the buyback as well as the RHG announcement on that ATO decision. The second largest position in our portfolio is Bravura Solutions Limited. Bravura is currently trading at 22.5 cents per share and is up 50% over the last 3 months. Bravura announced on the 10th of December 2010 that it had had a number of indicative takeover offers for its business, and as such had employed Macquarie advisors to evaluate those offers, and the speculation in the Australian Financial Review more recently is that the evaluation of those offers tend to have been around 29 to 30 cents per share. The recently announced results for Bravura also indicate that the company is in a continued turnaround situation, and that the annuity proportion of their revenue has actually increased, which is good news for shareholders. The Reckon position is our third largest position and probably the oldest position in the Cadence Capital Limited portfolio. We first started acquiring Reckon shares at 15 cents per share when the company had 12 cents of cash per share on its balance sheet. The share price is now $2.50, and the share price is up 6% over the last 3 months. Reckon has displayed continued earnings growth of in excess of 10% per annum over the entire period that we've owned it, and that's about 6 years. The earnings for the half year, half and half, were up 12.5%, and we're very pleased with the recent results. We believe on our numbers that the price increases that have been put through for Reckon and the continued annuity style nature of the business means that they should comfortably be able to deliver in excess of 10% earnings growth in the year ahead. This business has been particularly good in recent downturns, and the annuity style nature of the business has meant that the share price has been fairly stable over time. South Boulder is our fourth largest position and is a position that we started to look at when BHP expressed interest in buying potash assets around the world. South Boulder, we started first acquiring at around 32 cents, and the current share price is $2.59. That's up around 300% over the last 3 months. The South Boulder management have indicated that their drilling results have revealed a high-grade, low-capex potash discovery in Eritrea, and that these assets will potentially be one of the largest deposits of its type in the world. Should production levels reach the mooted numbers in some of the broker reports around 2016, 2017, they will be producing 20% of the world's potash production. The share price performance has been excellent over the last 3 months, and we believe that a reiterating by STB of their biggest asset will continue to revalue the business. The final position that I'd like to talk about is McMillan Shakespeare. McMillan Shakespeare's current share price is $9.66, and it's up 36% over the last 3 months. Bear in mind that McMillan Shakespeare floated at 50 cents per share several years ago, and in that sense is a 20 bagger, or has produced 20 times its original share price to date. We reinvested into McMillan Shakespeare approximately a year ago, and the share price has almost tripled in that period. The two things that have been very important for McMillan Shakespeare are the acquisition of the interleasing business at very good prices just after the global financial crisis, as well as the outcome of the Henry Review, which was said at the time to potentially affect the fringe benefits tax regime. Now, the fringe benefits tax regime has remained largely unaltered, and as such McMillan Shakespeare's business and the continued annuity style nature of the revenue remains intact. We expect that McMillan Shakespeare, with its interleasing business and the organic growth that they're experiencing within their traditional business, should result in at least a 30% earnings per share growth number for the full year ended June 2011. That sums up the 5 top positions within the portfolio, as well as our half-yearly results. As always, I would encourage any shareholders or potential investors please to visit our website at cadencecapital.com.au. And if you wish to contact us via email or telephone, please feel free to contact us at any stage in relation to our portfolio or our investment company. Thank you very much.